Our next guest says higher rates for longer opens up opportunities in the credit market. Joining us now is Brian Higgins. He is the founder and managing partner of King Street Capital Management, a global alternative asset manager with about $23 billion under management. First time on TV, too, if I'm correct. So welcome.
Well, thanks for having me.
So I do want to get your thoughts on that. Before we get into the actual opportunities around credit, the fact that you do have the soft landing narrative that has not only seized the market, but it is making its way out in the Fed speak we've been getting in recent weeks, too. Do you see it the same way, or is this the calm before the storm?
Well, we're credit investors, as you noted, and as such, we look at the world as half empty versus half full. And so while we're constructive in certain areas of credit, it's really about dispersion. And so if you think about monetary policy, the transmission system occurs through refinancing. And if you look at the loan market, that's been able to happen more quickly because they're floating rate instruments and they're shorter duration. However, if you look at investment grade, much longer duration, high yield, longer than loans but shorter than IG. And so there'll be time as these refinance and those rates will go higher. And then you'll start to see the pinch in the credit markets. I think some of the lenders, as you noted earlier, are pulling back in higher credit standards. On top of that, Basel III regulations, the Fed's coming out with new guidance and rules there. And so the capital for the banks and the regulatory environment would mean there's tighter credit standards. And so banks in general, it's a challenge for them because their cost of capital, they need sort of 10, 12%. And so on that, that creates great opportunities. We're a long-short credit investor, and so dispersion is good for us, and we're excited by that.
Okay. I mean, we could talk about the wall of maturities. We can talk about leveraged loans, which are starting to get a little more attention as well. Are there areas in this market that are concerning you as well as providing opportunity right now? I guess when you talk about dispersion, how are you thinking about that?
Well, if you look at the overall indexes, the high yield index, you look at the investment grade index, most of the returns come from the base rate, not the spreads. And so as you roll forward and think about if we do have some sort of slowdown or rates go down, you're locked into these rates. Either way, whether through a credit or rate perspective, it's going to be a challenge. And this comes on the heels of 2 years where the investment grade indexes had down years, which hadn't been happened in generations. And so one is to be mindful that you're making these longer term bets in fixed income securities. You need to be compensated for it. And so we try to price illiquidity. And we look at what the credit markets are doing, what the underlying companies are doing. And while there's strong top line, I think it's important to note within these high yield and investment grade markets and loan markets, there are difficulties. And that's the beginning. We call the worst go first.
Okay. So if I'm a company right now looking to issue debt, I think part of what you're saying is I've got to pay better, right, than investment grade, than government bonds, and so it's going to be expensive for me. So if I'm playing at home, can I buy riskier corporate debt right now, or is that dangerous? Do you want to wait until you see how both the Fed and the consumer for the rest of this year pans out?
Well, as you said, there's a lot of debate on the economy and the base rate being quite high. If you look at short duration, we're looking at short duration, higher quality liquid situations, which produce high single digit yields. And so if you're at home and you say, I want to play the risk-free rate 4 or 5% when you're used to getting zero for quite some time, that's quite attractive. And I said earlier, the spreads as it relates to high yield and investment grade, you're not getting as much as historical. And so if you look at the lending, if the banks are right and they're saying, okay, things are going to get more difficult, generally speaking, the economic expectations are lower, the spread should be higher. And that's sort of the forward curve. So default rates have been quite low. But if you look at the loan market, think about the loan market. We went from 3 to 6% in defaults.
Right.
Recovery rate, only 20 cents on the dollar. Traditionally, that's 70 cents on the dollar. So that would be concerning to me.
So this is the worst going first.
Correct.